Spouses running a small business together often accidentally create a partnership for tax purposes, but there's a shortcut called the Qualified Joint Venture, or QJV. On the EA exam, they'll test when you can skip Form 1065. The key idea: QJV is only for married couples filing jointly, and only when the spouses are the only owners and both materially participate. If you qualify as a QJV, you do not file a partnership return. Instead, each spouse files a separate Schedule C for their share of income and expenses, and each spouse files a separate Schedule SE for self-employment tax on their share. Exam tip: if the fact pattern says married filing jointly plus both work in the business, your brain should immediately ask, QJV possible? Now the trap. Once the business becomes a state law entity like a multi-member LLC, the default is partnership treatment and Form 1065. In general, spouses cannot use QJV for an MMLLC. But there's a narrow exception for community property states under Reverend Prox 2002-69. If spouses co-own and operate an LLC in a community property state, they can often keep reporting like a QJV. Memorize the community property list for exam purposes: Arizona, California, Idaho, Louisiana, Nevada, New Mexico, Texas, Washington, and Wisconsin. Here's how they'll ask it. Spouses form an LLC mid-year. In Hawaii, QJV ends and Form 1065 starts. In Texas, they may continue QJV-style reporting because it's a community property state. Next, farmers. Farming is about the activity, not the entity label. If the business is primarily crop production, animal production, or similar farm operations, and it's a sole proprietorship, the reporting form is Schedule F, profit or loss from farming. On the EA exam, they'll give you a ranch, orchard, poultry operation, or timber farm, and ask which schedule it belongs on. Now, tax-exempt organizations. IRC 501(c) requires an exempt purpose, and the big rule is no private inurement. Earnings can't benefit insiders like founders or shareholders. Also, a nonprofit can't be a sole proprietorship or a partnership. It has to be organized as a corporation, a trust, or an unincorporated association. That entity form rule shows up constantly in exam questions. Finally, EIN triggers. A sole proprietor with no employees usually doesn't need an EIN, but can get one for privacy. The must-have situations are what the exam loves. If the business has employees, or it operates as a corporation, partnership, trust, estate, or exempt organization for tax purposes. Also, if it files certain returns like employment taxes or excise taxes, withholds for a non-resident alien, or sets up a retirement plan. Which of the following organizations could not receive approval for tax-exempt status under IRC 501(c)? 3. Think about a local chapter of the Salvation Army, a partnership formed for educational research, a college alumni association, or a local boys and girls club. Which one is automatically disqualified based on how it's organized? Think about it. The correct answer is the Partnership for Educational Research. A 501(c)(3) organization can't be organized as a partnership or sole proprietorship. It must be a corporation, a trust, or an unincorporated association, and it must meet the exempt purpose and no inurement rules. The tempting wrong answer is the Alumni Association, but those are commonly organized as qualifying nonprofits. What is a necessary first step for an organization applying for tax-exempt status? Options include forming a board and holding an initial meeting, requesting an EIN, applying for exemption, or creating an organizing document. Which step has to happen before the IRS will even consider the exemption application? Think about it. The correct answer is creating an organizing document. Before applying for exemption, the organization must be legally formed, like articles of incorporation, a trust instrument, or articles of association. And that document must limit purposes to the 501(c) category and dedicate assets to exempt purposes. Requesting an EIN is important, but it's not the first legal formation step.